Hi, this is Jack from Alpha Charts with a state of the market update for March 1st, 2020. Before we get started, this is not a recommendation to buy, hold, or sell any stock or security. This is for informational purposes only. I may hold positions in some of the stocks mentioned. Know your time frame and risk tolerance. All right, so this week in the market was a pretty rough week, and so we're gonna do a kind of more of a zoom out recap, and just look at where we came from, and maybe some possibilities. Obviously, nobody knows what's gonna happen for Monday or the rest of this week or any time in the future. So all we can do is make plans on if and make if-then statements, right? If this happens, then we do that. All right, so starting with the SPX on the weekly, I put Fibonacci retracements here from the lows in 2009 all the way up to where we pulled back. Now, as you can see, this pullback in 1 week, as everyone knows, was really significant. Like, everybody was heading for the exits all at the same time, right? And whatever happened on Friday with this little snapback over here, I think that's guilty until proven innocent. Because, I mean, you don't see this type of exiting and people going back and buying back their shares the next week. That just usually doesn't happen. You can see here, you have exits here, and then it chopped around for weeks on end, went lower, and then finally bottomed. So, where are we? We are right here, and I think this is a really important level, right? I mean, this has been the prior highs, which had resistance and finally broke through back in September, and then off to new all-time highs, right? So that's a big deal. Now we're back here retesting it. It could be a normal test, and we just go higher from here. That's a possibility, right? I think that's the lower possibility because of all the unknown out there with coronavirus. And I mean, people are just canceling conferences and canceling and all kinds of things are just not being done, right? So if things aren't being done, a conference, you're talking about, from caterers to transportation to hotel rooms, all those things just aren't getting bought or sold. Uber drivers aren't being utilized. So again, it's just decreasing the flow of money in the economy and slowing down growth and sales. That's going to have to be, reconciled. I think that's what we're starting to see. That people are starting to say, hey, wait a minute. The economy is slowing because people aren't traveling and doing things and spending money in the same way that they were. So here we go. So we're here. I think looking at just Fibonacci retracements, again, from the 2009 low, I think 2750-ish, that's an important level. And then below that, 2351. Right, so these are the levels I'm watching to see the price action that goes on at these levels, and then we'll take it from there. Right, one day at a time. That's all we can do. So moving on to the Qs. Qs held up better, and they are still in this nice channel. You can see from 2010, 2009, not 2010. So it's still in this channel. Hit the top. You see it's gone from top to bottom quite a few times. Right. It did it here, right? It did it here to there, did it from here to there, and now we're here. So there's a good chance we're going to go top to bottom. Now, if this channel doesn't hold, then you have this level, which was the 2000 highs here, that I would be concerned about hitting. But that's way, way, way lower. So from history, we can guess that maybe this would be the area that would hold. Again, if and when it comes down to this area, that's the place where I'm going to be interested to see. Intermediate term, this 194, 195 level could be something that could hold a support, but from past history, top to bottom seems like what it tends to do. Looking at the IWM. Again, this one never made it back to all-time highs and is rolling over. This 145-ish level, again, really important. We roll over, and if we get below 140, I think that we can easily fall to the 120. And that's a pretty big drop. I mean, we're talking let's see, from highs to lows, right, from, we'll call it these highs, to 120, that's 30%, right? So that would be a 30% drawdown, which would be very significant, right? So hopefully these levels do hold for the bulls out there, but we won't know until after the fact. So again, this is the level, 140, 141, and I think then 120. Those are the ones that I expect to maybe offer some support. Dow Jones composite average, this one breaking down hard like everybody else. Big volume, everyone heading for the exits at the same time. Just looks really, really bad. Now, I'm going to pull up here. Let me pull this up now, actually. So, here's Alpha Trends, Brian Shannon. He made this understanding market structure, and it's been awesome. If you kind of follow it, you see we're kind of in this distribution area here, most likely. And then it kind of creates a bull flag, and then you have another potential leg down. Now, in this, I can definitely see a scenario like that where we get, whether it's this week or next week, some support being held, and we get some choppy upward motion, and then a second leg down. So that's something just to be aware of. I wanted to bring that up because it's a great little reminder of the way markets work and market structures. Okay, so let's look at the XLF. So, back in 2007, this was a very important area. Again, in 2018, it came back up, retested. We had a little breakout. I was pretty excited about this breakout, and it just completely turned over. So this is super bullish financials. Obviously, it goes with the idea of economy slowing down and the decrease in movement of money. I think this is a super bearish look to it. Again, if we bounce back and this 150-day EMA holds, okay, cool, that's good. We made maybe a higher low from here, and everything's hunky dory again. We won't know until after the fact, though. So this is the level where I think we are at the level that looks really important, and then 22ish. All right, so that's where I would go below that. Semiconductors. So semiconductors held up reasonably well, right? They're just, let's see how much they are off their highs. They closed at about 13-14% off the highs. Okay, so, but they're definitely an uptrend. And if you look at them versus the SPX, let me just do this real quick. So versus the SPX, again, they're holding close to the highs in a relative basis. So that's something just to be aware of, that semiconductors and technology held up a little bit better than the regular indexes, but it still breached expected area of support, and you still can get a nice rollover and a retest in this, anywhere from 100 to 110 level. Yeah, that'd be really possible. So just be aware, just because it held up better on a relative basis doesn't mean that it is doing better on a absolute basis. It could still cause some harm. Looking at lumber. So lumber, again, big uptrend, came down, chopped around. This 52 to 54 level, super important. We could come back and retest it as long as it holds. Great. We go below that, I think lumber is telling us that the slowdown in the economy is for real, and to batten down the hatches because things could get worse. Looking at the put-call ratio, I'm going to go to a daily on this one just to show some of the gyrations a little bit better. Okay, so we were way over, we were oversold, or at least overly bullish here, and we got the snapback, right, and got a little bearish, and then we closed over here. Now, this doesn't scream bearish to me, right, at all. Even this doesn't scream bearish. It's bearish, but it doesn't scream bearish. I mean, this screams overly bearish. This screams overly bearish. But this right here, not so much. So I don't think that there is a significant amount of fear in the market yet. So that's one of the reasons why I think that we may have a little further down to go before we can start calling bottoms and see constructive bases being formed. Let's look at high yield bonds next. This was an area that we were really interested in right here. Hit it, came back down hard, hit it again, and totally collapsed. So if high yield bonds, which is a risk on indicator, are going almost straight down, I think that's a negative for the market. I think that we should take notice of this, right? People are going for the exits. They're going safe havens. Now, gold is interesting because that's traditionally a safe haven, right? And you see we broke out, and now we've retested that breakout. That's kind of normal. And I read a really interesting article on why this sell-off happened here on Twitter. And I think I reposted it. But the point is that what may have happened here is that people that were leveraged long got margin calls. And gold was the asset they sold to keep their positions to satisfy the margin calls. So that was the theory, and there's a lot of good charts that would support that theory on why the snapback had. So at this point, gold may be a really good risk reward right here, right? I mean, we have an uptrend, that's for sure. We broke out, we retested support, right? If we get a move higher here, gold may be pretty good. All right, so let's look at one more chart. And we're going to look at the value line geometric index. So you see, let's go to weekly. All right, so here we have this very important level, which was around 500 or so to 515-ish. And we had this nice breakout. And then we kind of chopped around a little bit in this area. And now we decisively have moved down. I think that 455-ish is a significant area in this value line geometric index. But if we see a rollover and it continues further down, I think that, again, this is more, we don't trade this, it's more of an indicator. That would say that broad market weakness is persisting, and that's as risk off as you can get. With that being said, I ran some charts this weekend and some relative strength stuff, and there are some great looking charts out there that once this weakness subsides, and it will subside, and we don't know again if it's this week or next week, that there are going to be some amazing, amazing buying opportunities. I am super excited about creating a watch list and following that watch list over the next couple weeks until this market decides to stabilize, and if we can get a new uptrend, maybe a follow through day. I think that there are going to be some amazing opportunities. So really excited for what will be available to us. Again, it may not happen this week, it may not happen for a month or two or a few months, but it's going to be there. So make sure that everyone takes proper risk assessment of if any positions they may have. Keeping capital is job number one, right? Because if you don't have capital, we can't continue to trade. So we have to make sure that we always keep as much capital as possible in these drawdowns. And again, good luck this week, and we'll talk to you soon.